A Chinese audio company tried to go public 4 times in 3 years. Every attempt failed. In the end, the founders sold it for roughly half of what private investors thought it was worth. The company's called Ximalaya, named after the Himalayas. The easiest way to think about it is YouTube for audio. Podcasts, audiobooks, paid courses, all on one app. At its peak, private investors valued it at around $4.3 billion. From 2021 to 2024, Ximalaya filed for an IPO 4 separate times. Once in New York, 3 times in Hong Kong. Not one of them made it across the finish line. In June 2025, the company gave up on going public on its own. Tencent Music, China's dominant music streaming company, agreed to buy the whole thing for about $2.4 billion, roughly 55% of its peak valuation, half off. Chinese media wrote this up as a giant swallowing a unicorn. The timeline tells a more interesting story. Ximalaya didn't just lose to regulation. It got outcompeted by a younger rival who attacked the entire business model. And then, it missed the last IPO window. I'm a former senior product manager at Tencent and ByteDance. This is the story I want to tell. The story starts in 2012. Yu Jianjun was 35. He held a master's degree in engineering mechanics from Xian University. By that point, he had already founded 4 companies. His first company built 3D scene software for Hollywood. Its software was used in films like Troy and one of the Harry Potter movies. His second was a Chinese Street View product, launched before Google Street View arrived in China. His third was a virtual reality project that quietly died. Notice the pattern. Each one ended the same way. They either sold to a bigger company or they disappeared. Not one ever reached an independent IPO. For his 5th attempt, Yu picked online audio. He co-founded Ximalaya in Shanghai with Chen Xiaoyu. The model borrowed heavily from YouTube. Anyone could upload audio. Anyone could listen. 8 months later, the app went live. The market response was fast. Users climbed from 10 million to over 200 million within a few years. The money showed up too. Tencent and Goldman Sachs led the early rounds. By 2021, Ximalaya had raised close to $1.4 billion. The script, as everyone in Chinese tech understood it, was clear. Raise from top investors, hit 100 million users, file for an IPO, cash everybody out. Except the world has a habit of turning corners in places you weren't looking. In April 2021, Ximalaya filed an F-1 prospectus with the SEC. The target was a New York listing. 2 months later, Didi rushed onto the New York Stock Exchange. Within days, China's cyberspace regulator launched a data security review into Didi's app. A new rule came soon after. Any Chinese company with more than 1 million users had to clear regulatory review before listing overseas. Ximalaya had over 100 million monthly active users at that point. It walked straight into the line of fire. Washington was tightening at the same time. The Holding Foreign Companies Accountable Act required Chinese firms to open their audits to U.S. inspection or face delisting. In September, Ximalaya pulled its U.S. filing. 4 days later, the company pivoted to Hong Kong. But Hong Kong's IPO market was frozen. Ximalaya was still losing about $100 million a year. Its Hong Kong listing window lapsed. The prospectus expired. In March 2022, they tried again with a refreshed Hong Kong filing. Same outcome. Window closed. Prospectus expired. The 4th attempt came in 2024. On paper, this one looked like the best shot. The company had just posted its first full-year profit. They upgraded the underwriting bench to Goldman Sachs and Morgan Stanley. But the fundamentals had moved. Revenue growth had slowed to 1.7%. The growth story, the thing public investors actually buy, had broken. Pre-IPO investors wanted a valuation of around $5 billion. Public market buyers were closer to $2.5 billion. Nobody could agree on a number. The deal didn't happen. 4 IPO attempts. 3 years. 0 listings. This wasn't bad luck for one company. It was a generation of Chinese unicorns hitting the same wall at the same time. And by then, something worse was happening underneath the financials. If you tell this story as a regulation story, it sounds too clean. 2 things were killing the independent IPO dream. The outside cause was regulatory timing. The inside cause was ByteDance, quietly breaking the business model. The challenger was called Funky Changting. You can loosely translate the name as Tomato Listen, but the key point is that ByteDance launched it as a free audio app in 2020. The business model was the exact opposite. Ximalaya charged a monthly subscription to unlock premium audio. Funky was free. You listened for free, with ads. The money came from advertisers. You might think this sounds like Spotify free versus premium, It's not the same fight. Fanqi was sitting inside ByteDance's traffic stack. Douyin and Toutiao together reach more than 1 billion users in China. ByteDance can funnel that traffic to Fanqi at effectively no acquisition cost. Ximalaya, a standalone company, had nothing close to that pipe. By the middle of 2025, Fanqi had hit 130 million monthly active users. Ximalaya's mobile paid subscribers were around 15 million. That's an order of magnitude gap. Here's the PM take. ByteDance wasn't building a better audio product. They were using an asymmetric distribution strategy. Free content, ad revenue, billions of impressions from Douyin promoting the app at no cost. Subscription moats don't survive that combination. A standalone audio company simply cannot match a competitor with 1 billion users in adjacent products. The math doesn't work. By the fourth prospectus, investors were no longer seeing a clean financial story. They were looking at a company whose moat was dissolving in real time. Here's the strange part. Why, in 2024, did Ximalaya still fail to find an IPO window, even after turning profitable and posting 9 straight profitable quarters? 3 things hit at the same time. Growth stalled. Valuation didn't match. The competitor took over. Growth first. Revenue rose just 1.7% year over year. That's not a slowdown, that's a ceiling. Without growth, all you have left is a price-to-earnings story. The valuations that math produces are a fraction of what the last private rounds implied. Valuation second. Pre-IPO investors had anchored to 4.3 billion. Public buyers were willing to pay half. Existing investors refused to take a 50% haircut, so they killed the IPO themselves. Competitor third. Fanqi's monthly active users had already passed Ximalaya. The leader in long-form audio claim was no longer holding up. Public markets priced the future, not the past. The profit was real. The story behind the profit had stopped being credible. Ximalaya was left with 2 options. Go public at a haircut and risk a revolt from pre-IPO investors, or sell at the same haircut and let everyone exit with some dignity. They picked the second option. In June 2025, Tencent Music signed a merger agreement. The total deal value was around $2.4 billion, roughly 55% of the 2021 peak valuation. In May 2026, China's market regulator approved the deal with conditions. We'll come back to those conditions in a minute. They matter. So why Tencent Music specifically? Tencent Music already owns the major music streaming apps in mainland China, but they had a blind spot. Long-form audio, podcasts, audiobooks, paid courses. The 3-minute song format doesn't cover any of that. Ximalaya fills that gap cleanly. The more interesting question is how Tencent Music chose to play long-form audio. They picked a path that's the exact opposite of what Spotify did. Spotify spent years buying podcast companies and podcast rights. Anchor, Gimlet, Megaphone, and the Joe Rogan deal. Roughly $1 billion in total spend. When the Joe Rogan deal got renewed in 2024, Spotify quietly dropped exclusivity. That renewal looked like a public retreat from exclusivity. Tencent Music skipped that fight entirely. Instead of paying for exclusive shows, they paid $2.4 billion for the whole platform. What Spotify bought was a mix of podcast companies, ad tech infrastructure, and some major exclusive rights. What Tencent Music bought was a creator ecosystem, hundreds of thousands of content producers, licensing relationships, and a paid subscriber base. The other piece is cash flow. Tencent Music's subscription business alone brought in about $2.1 billion in 2024, almost the entire price tag of the acquisition. Tencent Music didn't need to raise capital. They didn't need to dilute shareholders. Spotify back in 2019 didn't have that cushion when they bet on exclusives. The PM take is simple. Your competitor tested a strategy in public, and the results were disappointing. You have the information advantage. Your cash flow can cover a different bet. So you make the different bet. The regulator's 5 conditions actually helped Tencent here. One of them specifically targets audio content exclusivity. The rulebook forces Tencent Music to skip the trap Spotify already walked into. Pull the camera back. This isn't just one company's story. From Didi to Shane, this generation of Chinese unicorns has been hitting the same wall. Didi listed in New York, then moved to delist under regulatory pressure less than a year later. Ant Group's IPO, which would have been the largest in history, was suspended by regulators days before pricing. Shane has been cycling through 3 possible listing venues. Its valuation has been cut roughly in half. They all share one feature. Their private valuations had floated above what public markets were willing to pay. Low interest rates and the internet boom pushed private valuations far above any earnings story. Then, rates rose. Regulators tightened. Business models got attacked. This generation hit two walls at the same time. The overseas path looks different. Spotify went public and then bought into podcasting, while Audible was acquired by Amazon much earlier. Mature players doing strategic consolidation. When I was at ByteDance, I watched several overfunded incubation projects hit the same wall. Once the valuation flywheel spins past what public markets will pay, no one is left to support that last private round price. The only exit is often to sell to a larger incumbent or get absorbed into a bigger platform. Tencent buying Ximalaya is structurally the same move at a different scale. An 8-year financial investor becoming a strategic owner. The real takeaway isn't Tencent ate a unicorn. It's quieter than that. Once a whole generation of companies can't clear the valuation implied by the last private round, big tech absorbing unicorns becomes the new shape of the market. For Chinese unicorns of this generation, the path to a standalone IPO is closed. For Ximalaya, the ending isn't dramatic. 14 years of building, 4 walls, and the moment when you accept the math,